We got some massive news for Tesla stock investors as the company reported quarterly financial results that included details on several critically important product features, product enhancements, new products, profitability, cash flow. There was a lot to understand from these companies' latest results. Now, I'm going to look at these figures in detail and explain what these could mean for Tesla stock investors. But what I'm not going to do is be a cheerleader for this company. I'm not going to go ahead and just hype up this company and tell you it's going to be a $10 trillion company or $100 trillion company, and everybody's going to buy a robot and everybody's going to everybody's going to be in driverless cars, etc., etc. There's plenty of other YouTube channels you can go to for that where they're just being cheerleaders and not evaluating the company's actual results. So let's take a objective view of this company and look at the actual results and try and understand this latest development for Tesla.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Tesla's total revenues decreased by 12% in the most recent quarter to 22.5 billion. And some of the factors that are hurting the company's revenue is lower regulatory credit revenue. These are very high profit margin revenue sources. This is other car companies that have to pay Tesla because they're not producing enough electric vehicles. Now, this was a several billion-dollar annual revenue source for Tesla, and it's going away. The new legislation in the United States is removing this, and this highly lucrative revenue source is going away for Tesla by the end of this year. Also, the company is losing out on the $7,500 vehicle tax credit. That's also being removed by September 30th in the United States. So, two huge sources of revenue, sales, and catalyst for the business are being removed. And you can understand why the CEO threw a big tantrum when this legislation was enacted in the United States. Of course, he complained about other factors included in this legislation, but most notably, it's going to hurt Tesla's car sales, to be sure. Also, something new this quarter is a decline in the energy business. The energy business had been one of the brightest spots for Tesla, while the EV business had been slowing down and now is in free fall. The energy segment was doing great. This was driven by a boom in demand for artificial intelligence. And one of the main constraints for these new data centers optimized for artificial intelligence was power, a power source. And so the demand for energy has been soaring, and Tesla's been stepping in and filling that demand, and its energy generation and storage segment was booming. But that's now in question as well. In the latest quarter, energy generation and storage revenue declined. Tesla says as a result of lower average selling price, and that's going to be hurt even further because the primary supply chain for these products that Tesla's selling is from China, and China's being hit with a tariff rate that's way higher than it was last year. And so that's going to impact the energy segment. And Tesla's management team even admitted that the energy segment is going to be hurt even more than the car segment as a result of tariffs. And we're already starting to see the early signs of that segment entering into a period of potentially continued declines instead of continued increases. And this is all being offset, or this is all being on top of the company's increase in spending. They increased operating expenses significantly to invest in artificial intelligence and other R&D projects. So overall, their operating income crashed by 42%. So revenue fell by 12%, operating income fell by 42%, and this is now two consecutive quarters of revenue declines and operating income declines, much bigger than revenue declines. So zooming out a little bit, this is a vertically integrated business. And while for many years, Tesla stock investors have been boasting that this is an advantage for Tesla, having everything under one roof, it turns into a disadvantage when your business is going through a decline, as Tesla is going through right now. And so when revenue fell just 12%, its operating income fell by 42%. And this is a characteristic of a vertically integrated business. Being vertically integrated is not always a good thing. Sometimes it's a bad thing. Sometimes you can generate a better business model by not having everything under one roof. Maybe a company, a third party supplier can offer you those services at a lower cost to your company and be able to scale quicker than you can do having those segments vertically integrated. So it's not a no-brainer. It's not always a good thing. And I think Tesla stock investors have become too comfortable in saying that it's guaranteed, it's a no-brainer, that it's a good thing. It's not. It's really not. If you study business, and of course I teach business at university, I teach finance, economics, accounting, business, competitive strategy, you'll understand that vertical integration is not always a good thing. And in fact, in recent decades, it's becoming more favorable to not be vertically integrated because information systems and technologies have improved so much that it benefits operating under a more asset-light business model and outsourcing some of these services. A couple of troubling signs also, there were so many, but a couple more. Other model deliveries in the quarter fell by 52%. So other models include the Model S, the Model X, and most importantly, the Cybertruck. This is a new model that was supposed to generate growth for Tesla, but sales in this other segment are down significantly. So the Cybertruck is not generating anywhere near the levels of sales that the management team initially thought. In fact, they have capacity to produce over 125,000 Cybertrucks. They're nowhere near that level. So that's wasted capacity. That's wasted research and development spending in creating that model because it's not generating the type of return on investment that investors were hoping for when that model was announced several years ago. Uh, that segment likely continuing to struggle going forward. Another area of concern is inventory levels are rising. The company now has 24 days of supply of inventory, and that was up from 18 days of supply in the same quarter last year. Now, this is not always a bad sign when your inventory is increasing. In fact, when your sales are increasing, then it's a good sign to have more inventory because you're prepared for that increase in demand, right? So that's likely going to lead to an increase in sales in the future. But that's the opposite of what's happening with Tesla. Their sales are falling and their inventory is building because they're not selling the things they're manufacturing. That's a bad way to increase inventory, right? So in the third quarter, the company's sales are not likely to rebound by all that much, probably not even in the fourth quarter. They did note that they're uh, ramping up production of the lower priced model, and hopefully for Tesla stock investors, that can generate some sales growth in the back half of the year. That was the one big bright spot from this latest quarterly earnings release, is that the management team did acknowledge that they are ramping up production of that lower priced model. I was a little concerned for Tesla stock investors who were promised, remember, for many years they were promised that Tesla was going to deliver a $25,000 model. Many, many years of promises for that $25,000 model. And in recent quarterly reports, when Elon Musk was asked about that, he kind of brushed aside investors and said, don't pay attention to that. If you're investing in Tesla because of EV sales, then you shouldn't be investing in the company, and really just downplaying that lower priced model and trying to shift investor attention away from that. And so I was concerned that they were just going to scrap that entirely and not sell that lower priced model, which would be really bad news because right now, the only way the company can invest in development of robotics and driverless car technology is by selling electric vehicles. That's what's generating the cash flow for the business, which they then use to develop this new technology. If sales continue crashing for electric vehicles, that's potentially negative cash flow in the company and burning through the company's cash. And then how are they going to invest in driverless car technology? Where is that money going to come from? It's going to come from you, the investor. They're going to come to you and say, look, our EV sales are falling. We don't have enough cash to invest in driverless cars. We need to sell more stock. We need to borrow more money to fund the development of that technology. And you have to do it, because if you don't, then really our company might just go down significantly in valuation, because so much of Tesla's valuation is dependent on driverless car technology and robotics. Because if you were just looking at Tesla as a car company, it's trading at like 30 times, 40 times the valuation of other car companies. So if it's not developing driverless cars, if it's not developing robotics, then you have to value the company as a car company, and the valuation could crash closer to other car companies. So that's the predicament it finds itself in. It needs to continue generating cash flow from EV sales, and that segment is struggling, as you saw here. And so hopefully that lower priced model does come out, and it is close. I don't think it's going to be $25,000. But even if it's closer to $30,000, even $32,000, anywhere in that range, I think it can generate excitement among a new group of car buyers. And of course, people who buy Tesla, a $30 or $32,000 Tesla model, some of them will upgrade to supervised self-driving, which is a high profit margin business. Some of them will use Tesla superchargers. And so in the future, when they develop, if they develop robo taxis, some of them can be put out as potential robo taxis. And so it can enhance the business further if they actually develop that lower priced model close to $30 or $32,000. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.